The very first question anyone needs to ask themselves when they're planning for retirement is, do I have enough? Have I put away enough money? Has it grown enough to be able to meet the goals that I have set out for myself in retirement? What I wanted to do today was to give you an example of the process that somebody like myself, a financial advisor, would walk through with a client to determine whether they've got enough. And then you can use that information to apply it to your own situation to kind of move the numbers and see if things look right for you. Now, before we get into all the nitty gritty and the numbers, you know that I regularly talk about the two sides of retirement planning. There's the emotional side, like what do you want to have happen? What are your goals? What are you trying to achieve to have a happy retirement? And then there's just the math of it. And the math of it, the numbers, have you put away enough money? What kind of investment returns might you get? What do the taxes look like? All of that supports the goals. In a good financial plan, all of those things should be moving towards helping you achieve those goals. Today's a math video. Today's not an emotional video. We're not going to talk about all of the fun parts of retirement. We're going to get into the nitty-gritty of what folks need to consider when they're looking at planning their own retirement. And we're going to do that using Brian and Brittany, our hypothetical made-up couple. So here we go. Brian and Brittany, they're 50 years old. There's $200,000 of annual household income, so they're both working. Let's say that Brian earns $125,000 a year. Brittany earns $75,000 per year. They've been saving, so they've been putting money away and doing all of the right things, which is great because they're 50. You certainly want to be started before that. Let's say that Brian's got $200,000 in his 401k at work, and Brittany's got $185,000 in her 401k, split up a little bit differently. She's got $160,000 in the traditional option, and her 401k plan offers a Roth option, and she's been watching my videos and she knows that we love Roths, and so she's got $25,000 in the Roth option inside of her 401k. They both get a 3% employer match. So let's say that Brian's putting away 6% per year. He gets a 3% employer match. So effectively 9% of his money, $11,250, is going away per year into the 401k. Brittany's got a 5% traditional contribution, a 3% match, and then she's got some additional money going into the Roth each year. And so she's saving $8,400 per year into the accounts. So here we go. They're 50 years old. It's the title of the video. At 50 years old, they're saving $20,000 per year. Actually, $19,650. But they're saving $20,000 a year for retirement. Now, if they want to retire at full retirement age, which for them would be age 67, that's when Social Security will kick in as the full retirement benefit, they've got 17 years left to go before they get there. I mentioned assumptions. The first assumption is about income. So we're going to inflate the amount of income that they need at 3% per year to maintain the existing standard of living. And then we're going to assume that they need to replace 75% of their income in retirement. Now, we're going to assume that they're netting $12,000 per month, $144,000 per year. That's what's actually flowing into the checking account for them to live off of. So how much income do we need to replace in retirement? Well, let's say that they need $12,000 a month right now. We're going to grow that by 3% per year to account for inflation. Fast forward 17 years, that equals $240,000 per year. Now remember, we're not going to try to replace all of that. We're going to try to replace 75% of it, which is a pretty good level of retirement income replacement, just to say, okay, quality of life, standard of living is going to be fairly similar. So ultimately, they're going to need $15,000 a month in future dollars 17 years from now to maintain the current standard of living. $15,000 a month, that's what they're going to need. Are they going to be able to get there? Will they have enough money to do it? I ran some baseline Social Security calculations. I'll throw them up on the screen here. You can see Brian, it's estimated, will receive $3,162 per month. That's based on current income level and then retiring at full retirement age. And that is not factoring in inflation increases. I'll come back to that in a second. The numbers for Brittany, $2,405 per month from Social Security. Again, not accounting for inflation. If we look at cost of living adjustments of Social Security over the last 20 years, they've averaged 2.2% per year. So cost of living, Social Security makes an adjustment every year. So if we adjust the Social Security for inflation, that's going to put Brian at just under $4,600 per month. That's going to put Brittany at just under $3,500 per month. We add those up, they're a little over $8,000 a month in Social Security checks. Now, I know that sounds bananas. That's 17 years from now. That's factoring in inflation and cost of living adjustments along the way, and for two pretty good income earners who waited until full retirement age to draw their Social Security. So we're almost halfway there, right? $15,000 a month is what they need. They're going to have about 8 coming in at this point. Can they draw the rest of it from the portfolio, or is there a risk that they're going to run out of money? So let's move on to that stage of the calculation. Now we've got 17 years until retirement. We know that Brian's got $200,000 put away. If it grows at 8% per year, by the time Brian gets to retirement, he's got $1,180,000 in his 401k account. Now, if we look at Brittany's side of the balance sheet, she's got $160,000 right now in the 401k, $25,000 additional in the Roth 401k option. With the same 8% annual return over the same 17 years, she's going to end up with a little over $836,000 of traditional money, and she's going to have $183,000 of Roth money. So the total portfolio value, the whole ball of wax, by the time they get there in future dollars, $2.2 million. $2.2 million sounds like a whole lot of money, so they're going to need $7,000 per month. That's the shortfall. They need to draw it from a portfolio value of $2.2 million. That's a 3.8% distribution rate. Now, here's where things get a little bit tricky. Sometimes you'll see 4% rule. You can draw 4% of your portfolio when you get to retirement without being too concerned about running out of money. In a vacuum, that math works most of the time, although it's been getting a little bit lower as time has gone on, where you've had people come out and say, well, maybe 3.5% or maybe 3% is the better number, specifically as interest rates went down for a number of years. Even though they're under 4%, even though they're at 3.8%, we've got 2 big problems here. One, the portfolio is almost all pre-tax money, and so drawing $7,000 per month isn't going to net them $7,000. They're actually going to have to draw more than that because they're going to have to pay tax on that money, which is going to throw the distribution rate off. And the second thing is we've just replaced baseline income here. We haven't put away money for the fun stuff, for the emotional side, to take the grandkids to Disney every year, to pay for college, to pay for the weddings, to travel, to go take the European vacation, all of the things that you work and save for throughout your years. And so technically on paper, they might be okay at this point. Even though it sounds crazy that $2.2 million wouldn't get the job done, we're talking about money in the future. We're talking about needing to replace a pretty reasonable level of income. And if we take a step back and look at it objectively, they're currently saving, if they're saving $20,000 a year on $200,000 of household income, they're saving 10%. I say it all the time, get to 15%. If you're putting away 15%, even if you're starting from the same spot, you're going to have a much higher likelihood of being able to get the job done than if you're saving 10%. So do what you can. If you're watching the video right now and these numbers are sparking a little thought, calculate how much you're currently saving. The longer your time frame you have until retirement, and the more time you can spend saving at that 15% level, or if you're able to do more, good on you. The higher the likelihood that when you get there, you'll be able to not just replace baseline income, but actually get to do the fun things, the things that you want to do when you get to retirement that you're working and saving for right now. So I know there was a lot of math in the video today. I hope that it was a little bit enlightening to you, just to walk through the process of how you might want to consider. There's lots of things we didn't talk about here because I didn't want to do a video that was 2 hours long talking about replacing one of the Social Security checks if one of them passes, looking at doing Roth conversions or ways to lower the tax bill. There's a lot more to it than this, but for purposes of a YouTube video, I hope that you found the video enlightening and I hope that you learned something. I thank you for being here. If you enjoyed the video, subscribe to the channel, come on back. We got lots of other stuff about retirement planning and saving for the future. Again, thanks for being here. I'll see you soon.